Good evening to all of you. Welcome you to today's webinar. Today we are continuing the discussion which we had last Friday, that is in the options rollover. This last week we explained that what are the types of options that we can consider if you are bullish in the market, because we were explaining that the market is still bullish and despite today's fall, I think we are still in a bull mode only. So we were explaining that probably you can look towards alternate to the futures, either through buy call option, which is not recommended. And in that case, we consider probably the spread, and the spread also has a certain limitation, because in case if there's a big bull run, you don't get the full benefit. Same thing with sell put spread also. So we decided that probably it is better to go for deep in the money call, which would probably reflect like a future, so that you don't need to pay too much of a premium in a bull market. Okay, certain times there are swift changes, but that happens in the market, so you have to have a consistent method of doing it. So now we are looking at what is the options rollover, right? So here, this is when you say rollover itself means that means we are looking towards shifting positions. That is, rollover means that we are trying to shift positions of one of the legs or both the legs. Okay, so we will come to what we mean exactly by the rollover. Let us say you are doing first in options. Okay, now let us say we are now doing 17,000 say 400 call. Now let us say that day we did market was close to 17,600 call, and today it is 17,400. Now there are two there are two reasons why you should do a rollover. Now, first of all, it is purely from money management point of view. That is, we want a replication of the futures. That is, the way a futures profit or loss comes, we want that. So we are not about whether loss or profit compared to the futures. We want a result which is something similar to futures, but we don't want to invest to the extent that you will be investing in the futures. So that is the objective of this. Okay, it could be told about the cash market also. So it doesn't matter whether you're talking about a cash market or whether about a futures market. So what you basically want to do is you want to invest less, but you want to get a result which is similar to the cash market or the futures. So is it possible to do? So that is first thing when we have the rollover. Second discussion will come to it later on. Now let us say we have already explained to you that if you want 1 unit of futures profit or loss to come, then in that case, if you take at the money option, that day it was 17,600, futures also was close to 17,600 on Friday. So you want to have imitate a futures profit or loss, or replicate, whatever you call it. In that particular case, you need to buy 2 units of call option of at the money. So always you buy 2 units of at the money call option, which will be equivalent to a futures. So let us look at what happened on 17,600 call on that day if you had bought, and today what has happened. So now the market has now come down to close to 17,400, which means we have lost more than 200 points compared to that day. So in the case of a call option, and in that particular case, we should be literally having a very less amount of money. That suppose if you have paid 100 rupees for 17,600, so that should effectively translate into a full amount of loss. That's what normally our calculation will be coming, right? Because you bought 2 units, futures is down by 200 points, so you want to imitate that particular thing. So let us see what happened as far as the loss in call option is concerned compared to what happened on Friday. Now, one thing that you must know that the rollover of the option. See, there are the reason why we're doing a rollover of option is basically to avoid a time decay, but play on the volatility. The reason for the rollover is that we must know that the rollover is being done here to imitate the futures. One, because the biggest drawback of option is time decay. So if you keep the option of the same strike and the market comes closer to the same strike which you have done by the end of expiry, then you lose the entire option premium. So in order to prevent such a problem, what we do is that we just keep rolling over the option. That means we are trying to prevent a time decay as far as possible. Not that we can completely eliminate, but we are trying to prevent or lessen that. The second thing is that by doing this thing, what we are doing is we are playing on the volatility. Volatility in the sense that let us say on the day the volatility is 12% or so, whatever it is. And so that means for the option weekly option price, which I was quoting at 100 rupees on Friday or Thursday and Friday for at the money, it would have implied that probably every day if the futures rallies by more than 80 points, so because on a single day the option price would have been 100 rupees, would have been 40 rupees for a one day expiry. So for the time being, I'm not going into a calculation, but I'm just those things have been explained in earlier sessions. But those who are interested can look at what should be the volatility for the present volatility. What is the range beyond which the option price as a is better compared to the futures? Okay, so that I leave it to you for this one. But for the time being, you take from me that right now for the present volatility in number of points, approximately 80 points in Nifty. 80 points in Nifty is based on the weekly option or even monthly option. 80 points movement compared to the previous day should happen. If that happens, then in that case the rollover of options that we are doing will be slightly more profitable than even the futures replication, right? So that is what we are attempting. Right now what we want is something very closer to the futures profit and loss or something better than that. Okay, so if there is an 80 point movement on a close to close basis every day, then we will be more successful in doing a rollover of the option even when compared to the futures, right? If it is slightly less than 80 points on a single day, then probably we may have some loss. But despite all these things, I think we'll have a result which is very closer to the futures movement, plus or minus 20% of the profit loss. Okay, so but the investment that is going to come is going to be considerably less. That is the reason why we are going for it, because we said that we are looking at the 100 rupees is the weekly option price into 50 units is 5,000. And even if you do 2, it is 10,000. So where is 10,000 and where is more than lakh? So this brings it down. This brings it down considerably. So that is the reason why we are going in for the replication of the option by by rolling over the option to every lower level as and when it comes down to that particular level. So let us look at what the price was on Thursday, 17,000 on Friday, 17,600, and what is the price right now. You go to NSE option price, and if you look at it, 17,600 today is going at 27 rupees. On that day, I think today it is 17,600 is 36, and what it is quoting is that so it has dropped by 67 points. It has dropped by 67 points. So that day it was probably so something closer to 100 rupees. That's what I'm saying. 36 plus 67. So approximately 103 points. Today it's dropped by 67 points. That means for every 2 units, okay, you would have dropped something like 134 points. 134 points. But let us look at the futures price. Futures price today is 17,396 compared to what it was on that day, which is closer to 17,600 levels or so. So that means in futures, if you have done the loss in futures compared to that day would have been something like 200 points, but loss in options today is 2 units into 67 or 68 is 136 rupees. So today we have bettered compared to the futures, we have bettered by replicating it in the option. Okay, and also when it was falling, at least we know, okay, we have done only option, we can just even leave it there, right? So now it has come down to 17,400 levels. So what you can do right now is, that day it was 17,600, which you did at around 103 rupees or so. Now you can cut it off. You can cut it off. 30 is 37 rupees or so. So some 66 or 67 rupees will be the loss. Now you want to suppose if you keep the 17,600 itself right now. If the market rallies from 17.4 to 17.6, what will happen? You will have a considerable amount of time decay. This 100 rupees will come down very significantly down. So the loss in options will be there, but in futures, since it rallied it fell down from 17.6 to 17.4, and it rallies back to 17.6, then the chances in futures you would not have made a loss. So what we want is something similar to the futures. That is our intention, but with a lower investment. So today, if you go for 17.4 buy. So now market is at 17,395 or 396. So what we will do is that 17,400 option will be the right option right now. And 17,400 is going at the same price, 1 or 2 rupees, right? 102 rupees because the volatility has increased. So it has come to the 17,400 is also going at 102 rupees. So what we will do is, now we will remove the so now we are going to remove 17.6 and now we will be with 17.4. So now we are going to be with 17.4 and you are going to pay 102 rupees. 102 rupees. And already we have lost some 67 rupees on one contract. So now this is going to be the our price for one single option. For doubled option we are going to calculate now. So compared to the futures, in futures we have lost 200, in option we have lost 136. So this is our net gain right now compared to the futures, and that is the amount that we are going to plow now to see what happens as far as the futures return is concerned. But the investment is still going to be only 10,000 rupees, right? So tomorrow we can see where it moves, what it can be done, all those things we can think about what can be done. So today itself we had a lot of possibilities of how the market vacillated. It fell down to 17.5, 17.470, 480 initially. Then it went up to 17,640, 650 levels, and then it came down. So probably you could have done one or two rollovers also possible within the intraday. Within the intraday, some one or two rollovers would have been possible also. But the net effect is that we have now rolled over into another option of 17,400 compared to 17,600 levels. So in this case now we have effectively now brought it down. 102 plus 67 is 169, right? So one single option is 169. So 17.4 plus 169. So this is the one single option's price, 17,569. Compared to that day, 17.6 plus 100, right? 17,700. That day it would have been 17,700 was our break-even price. Right now the break-even price is 17,569. So if you get 17,569, we are okay compared to the 17,600 plus 100, 700, 17,700. So this means this is even better than the futures which you would have bought at 17,600 plus. 17,600 plus. So we have effectively reduced our break-even cost further. So that means we are now started even slightly doing better than the futures, right? So better than the futures. So the coming days will tell us what probably will hold depending on the volatility that is there, what sort of gain, what sort of loss, what is going to happen, because we have got 3 days to expiry. So the option price should definitely come down from 102 rupees down. It depends on the volatility that we are going to have. So what will happen is that on the last day, let us say the option price is on 40 rupees. The last day when the market opens, normally you will have 25 or 30 rupees for the this one, that is the at the money option. So at the maximum what we need is something like that 25-30 rupees on either side. The movement should be 40-50 rupees from the open, which normally happens. Okay, so at that point of time, at some point which is very closer to the expiry, either on the last day after the open and then you get a swing, you switch it over to the next week or probably to another month, depending on the price that you are willing to pay. So because now we have, if you want, we can now even look at the next week, because now this week is coming a little closer. So probably you will have some problem. Then you can look at next week. So next week also will be slightly higher than 10,000. Instead of 10,000, you may be investing some 15,000 rupees or so. So still relatively very low when compared to the this one, that is the option for compared to the futures price. So if you want an alternate to investment where you want to reduce your investment considerably, you can definitely look at this particular strategy. Suppose if you do only one call unit of option, then it will look to be that instead of for 50 units, if you do only one call option like this, then the result that you are going to do is for almost 25 units of the futures. So if you want to do an investment only for 25 units of the option, okay, of the futures, but since there is nothing like a 25 units, since you have only 50 units as far as the Nifty is concerned, so you want to do it only for 25 units. Here is a case where you can do other money for 50%. That is only one contract. So one contract effectively means 50 into 0.5 is for 25 units. So you will have a profit or loss replicate it for 25 units and make money there, right? So this is what we call as the rollover of the option. And the for the rollover of the option in a system like this, in order to be successful, we just need 80 points compared to the futures. Compared to the futures, we need something like 80 points in a day, close to close basis, okay, or somewhere intraday or something like that. So 80 into probably we need something like 5 days expiry. So something like 400 points of total up and down movement. And in this week itself, if you see, we have already got on Thursday, the market swung from 17.6 to Friday morning, it was 17.8. And from 17.8 only it fell down to 17.6. So from Thursday, you had a swing on the upside up to 200 points. Then from 17.8 today, we have got 400. So you have got a 200 plus 400, 600 points of swing in this week. Not necessarily that every week will give like that. Previous weeks might have had much lower this one. But net and net, I think over a period of time, this will get probably adjusted. Okay, this will get 1 month, 1 week it could be lower, another week could be a little more. So probably over a period of 1 month or so, I think more or less we will get some adjustments, or over a period of 1-2 months. I think we will have a much greater adjustments that is done. So this is how the rollover of the option is being done, facilitated, because you need two things. One is a passive option. If you keep only 17.6 now, and by expiry day, let us say even if it goes down to 17.3 or so, whatever it is, there is a chance that it can bounce by 200, 300 points vigorously from intraday low and all. These days it bounces by 200 points also. We have seen today itself was a classic case when it was below 17.5 and then went up to 17,650, 660 levels. Chance that probably tomorrow it can just make one intraday low and then swing on the upside, and probably enter into a much higher level. Okay, so if that happens, then the 17.6 will become probably you will start losing your this one time decay. You will start losing your investment much more. So it is better to look towards now going towards 17,400 of the present level. And if it swings by more than 100 points either tomorrow, see there will always be a swing from today. High or low will always be some 100 points. Normally it happens that from the close these days there is always a swing of more than 80 to 100 points. So 80 to 100 points if you get, then just do the rollover. That is whichever way it is. So 100 points you keep and then do the rollover. So 80 to 100 points must be the place where probably one rollover has to be done as far as the option is concerned, in order to ensure that you don't lose much on the time decay. So if you want to be very active, this one, then in that case, you don't need to look for stop losses and all those things, because let us say you believe that the futures is going to go on the upside. I'm not saying this time it's going to definitely, markets can always become crazy, it can fall down from any particular level, all those things. But let us say you want to stay invested in the market. You want to stay invested in the market and probably head on to the market on any fall. Okay, if that be the case, then the first intention is that you have gone long, but you don't want to invest that much of money. So what is the alternative to invest for the lack of funds or for the lack of intention to invest that much of money? In that particular case, you may consider option rollover as one of the best alternative for a much reduced cash outflow, but for the same result. So whatever we talked about as far as the index is concerned, that applies for Bank Nifty, that also applies for stocks. So in Bank Nifty now it is 25 units. You can do the same thing as far as Bank Nifty. Then if you want to do, of course that is there for weekly option. So if you want to do it as far as let us say TCS is concerned, Reliance is concerned, you can do the same thing as far as, because TCS and Reliance, for of course any stock for that matter has its own issues there. But what I'm saying is that you want to get into some sort of rollover of the option. Then in that case, it is better to consider those stocks normally which gives much higher return compared this one compared to Nifty. So for example, Nifty TCS can give consistently has been giving some 25-30% return over a period of time. Then you will not mind spending a little bit on the time decay or some loss as far as the volatility is concerned, because the amount of profit that you are going to get is still significant. So you can try and do even in big stocks like TCS or Reliance or so. So you can keep a point up to which you will do a rollover. So there will be a point which will tell you beyond this the market is going to go down. So there is no point in spending more money in rollovers. Okay, more money in rollovers. So those positions can also be considered, and you can think about such a thing. So what you can do is that in that case, this is what we call as a tail end type of this one. So you can just have one put bought at some place beyond which you will not do a rollover. For example, in a weekly thing, probably getting points which is below 400 points normally does not happen. Okay, or below 400, below I would say 4 times the option price. It doesn't come much. Maybe 1, 2 times, 3 times it comes. And so, or even below 200 points comes only 10-15% of the time, 10% of the time or so. So you can consider some sort of this one, that is positions where probably you will have some protection at some lower level, and the remaining will work something like a futures, and the remaining will work something like a futures. So that is also an aspect that you can consider, because the reason why you are not in a position to go for the futures is that probably you wish to avoid keeping too much of laying too much of money on the table for investment to come, for the investment to happen. So the one alternative to doing deep in the money option is rolling over of the option. So we are only giving alternatives. We are not saying this should be done, that should be done, because each time it will all depend on what sort of view at that point, what sort of risk investor you are, and whether you would like to protect certain things. All those things will depend on each one's this one. So what are the alternatives that you can look? One is, of course, we have highlighted already, don't look for deep in the money, which will bear something like futures, and buy in such a manner that you don't need to spend too much of time value this one. So if that be the case, then in a weekly option you need to give 500 points away from the money in order to get something like the futures. The second thing is that in order to get something like the futures, even you want to have a much lower investment, then you can consider probably going for at the money option, where probably you do two times. So let us say 500 points away, and you feel that 500 points away you need to spend something like 25,000 rupees or 30,000 rupees, but you are looking only at some 10-12,000 rupees in that case. Then you can you have to think about doing the rollover of the option of at the money. So this is one way of looking at it. Of course, we don't recommend out of the money much, because normally when the rally takes place also, out of the money will not gain much out of the money, and unless you really have some sort of a big bull move in a single day, or big bear move in a single day. In those particular cases only you tend to gain something which is more. Okay, so that will happen in a very, very bullish scenario, or in an extremely bearish scenario. Maybe a stocks type will suit for this in the case of a stocks, because either the movement is going to be much on the upside or much on the downside. So there you can just try about replication of the futures with the help of slightly out of the money call option, or slightly out of the money option in case if you are bearish in the stock. So this is the roller of the option purely from money management perspective. This is purely one thing which can be considered. The second, of course, see, let us say that day 17,000 market was 17,600 plus. So if you bought a spread 17,600, 17,700 spread for this week, you would have paid 50 rupees. You would have paid 50 rupees. 17,600, 17,700, you would have paid 50 rupees. So let us say now what is the present situation right now? Present situation. So 17,600, 17,700. What is the present situation? Uh, 17,600 is 36 and this is 20. So you have got a So that day 17.6 was 103 and this was 61, so 42 rupees. So sorry, it was 42 rupees. So 17.6, 77, this gap was a 42 or 43 rupees is what you would have paid. And today this gap looks to be something like 16 rupees. So 16 rupees, right? So this is 16 rupees. So you have made a loss which is something like 26 rupees. You made a loss which is 26 rupees. So let us say you are taking this loss, okay? Now, so this is 26 rupees for this entire structure, 17.6 to 17.7. And now it has come down to below 17.4. So let us say you do a 17.4, 17.5. Now you are rolling it over to 17.4 to 17.5. So let's look at what is the present price for 17.4, 17.5. So 17.4 so 17.4, I think it is gone there. So So 17.4 right now is 102 and 17.5 is 61. So same thing, 40 rupees right now, approximately. This also is now 40 rupees. 17.4, 17.5 difference is also 40. Now let us say you took this loss of say 26 rupees, and so you are adding this 42 plus 26, 66 rupees. 66 rupees. So let us say tomorrow it comes down further to 17, slightly below 17.3, and probably you're now this was for a 200 rupees movement, right? The 26 rupees loss was for an almost 200 rupees movement. Let us say it comes down by another 100 points. And if it comes down by 100 points, then what happens is that this will add to be another 14, 15 rupees, right? So let us say 81 rupees, 81 rupees. Now that time, let us say you have a 17.3, 17.4. If it comes down by another 100 points, then you will do a 17.3, 17.4. And let us say that is also at 40. And you have already taken loss of 26 and another 15 rupees you are taking loss, so add another 40 rupees approximately. You will have the cost as 80 rupees. 80 rupees. But even if it comes from 17.3 to 17.4, it just jumps by another 10, 20 points. Okay, it comes from 17.3, it falls below 17.3, but there is a chance it can bounce back by expiry to 17.4. It just comes back to 17.4, even 17.4 is slightly plus, then you will not make a loss. You will not make a loss, right? Because it closes above 17.4. Closes above 17.4, you will not make a loss. But whereas even in the case of, so from the futures when you did at say 17.6 or so, this is now the market bounces back to 17.4. 17.4. And so even at 17.4, you will not make a loss here, but you will make some profits. You will make some profits. But whereas in the case of the futures itself, you can see you will have to wait for the market to climb above 17.6 for you to make profits. You will have to wait for the market to climb above 17.6 to make a profit. So what you can do is that you can just 17.3, 17.4, you can just wait, okay, don't do anything about it, and wait for this market to bounce back up to 17.6, and only above 17.6 you can again do a rollover. So what you do is when the market goes down, you keep rolling over these contracts. If it goes down by 100 points, another 100 points or so, you keep rolling it over. So probably up to 400 points, 300, 400 points, I think you will still break even. Okay, you will still break even. And so normally, the market does not go by much below 400 points. So that's the essence. Now, let us say the market was 17.6. So the market expectation is that it will not close below 17.2. Only in very, very hot cases, it will close like that. Okay, so you do the rollover up to say 17.3, 17.2. You don't do the roller beyond that. So even if you do a roll up to 17.3, 17.4, if it comes down by another 100 points, you do a rollover 17.3, 17.4, at the market, even if it goes below 17.3 by weekend, by before Thursday, let us say from 17.285, it just bounces back above 17.4 considerably by before close, you will still make money compared to the futures, right? So that is an advantage of doing the rollover if the market census starts going down, if the market starts to go down. So you may argue that no, then how many units you require, all those things will come, because if the market is going to be in a bull mode or something like that, then how many such units that you may require, all those things will come. So we will not go into that at this point of time, because then in that case, no, then what is the investment that may be required, all those things. But suppose if you want to put in an investment which is something similar to futures, then in that case you should have an edge compared to the futures, right? You should have an edge compared to the futures. So today, let us say we dropped down by 26 points, but the futures dropped by 200 points, which means you should have done something like 6 to 7 contracts approximately in this. 7 contracts approximately, if you have done this, it would have looked like a futures. So the investment also for 7 contracts of spread contract would have been something similar to the futures of 1 lakh, because every spread contract here also you would have spent some 15,000 rupees into 7, so 1 lakh 5,000, which is approximately similar to the futures. But only thing is that the investment is the same as futures, but the result can be slightly better. The result can be slightly better. The reason I am just giving this, it can be slightly better, is that no, you are not doing the rollover. You are now doing the rollover continuously, right? So tomorrow, let us say 17.3 it comes, 17.3, 17.4 you are doing the rollover, and when if the market closes at 17.6, you will still make, you will not make money here, but you would have made something like 20 into 7, 140 points. Even at 17.4 you would have made, up to 17.6 you would have made. So only above 17,700 or 750 levels, then probably the futures will look to be better. In that particular case, at that point of time, you can think about what to do with this. Okay. So what I'm saying is, if you do if you continuously do a rollover, it can tantamount to bettering the futures. Now, in this particular case, now you are doing this. So you for every 100 points you lost 14 points, and for every 100 points, because for 200 points you lost 26 rupees. So 13 to 14 points you lost. So that means what happens is that this is amount to, for every 100 points of Nifty you're getting 14 points means. So that means today you lost for 200 points you lost 26 rupees, right? So it is amount to 13%, right? 13 it amounts to almost 13%. So it is it tantamount to amount, say I would say 13 units. Okay, 13 units, because 13 units you would have for 13 units 200 points. Okay, you would have lost, right? So for 200 points you would have lost. So here 200 points into Nifty. So let us say you lost 10,000 rupees, right? 10,000 points. So suppose if I had bought how many I should have bought? So 75. So 75 1 unit of Nifty. Sorry, it's 50 units of Nifty, right? So 50 units of Nifty, 200 points, I would have lost 10,000 rupees. Okay. So but now if I have to lose only 13 rupees in each contract, then it is like 650 rupees, right? So for one contract I would lost 650 into 2 is 1,300 rupees. 1,300 compared to 10,000 in the normal case. So that means it is 13%. So that means it is as good as now having 13 units, right? 13 units, or probably for 10,000 rupees equivalent amount, 650 into 2,300. So 1,300 means I should have had something like 6 to 7 units. Okay, 1/7 of that, right? So that's the amount of units of profit or gain that I will normally make in a Nifty. So if you want to, but the investment will be only something like 15,000. Investment will be only like 15,000, so around the 13 to 15% of the thing. So probably I will have only 7 units, 7 to 8 units. I am replicating only for a 7 to 8 units, okay, of that particular Nifty. So that's how it will come. So you can think about all these things of what suits you as an investor, what suits you as an investor for doing this particular trade. That is, whether you want to ensure that you don't mind paying something like a future, but can you get an edge over futures profit loss? Can you get an edge over futures profit loss? That is, so if you are investing to the extent of a futures, then you should think about whether you can get something which is better than the futures. So that is one point which you should think. Second point is that if you don't want to invest that much of a futures, a result which is something very closer to the futures, but then in that case you should get something of a very low investment. So you should think about two things: a lower investment almost close to the futures profit loss, almost close, because there will be some difference, or an investment equal to futures but an edge over futures as far as profit loss is concerned. Whichever you feel is right, you can think about that. So whether you want to replicate something of a cash market situation here, or you want to replicate something like a futures market replication, you can do that. So there are only two important things in rollover that you have to consider. That is, what type of strategy. More than that, is that, or do you want an investment which is lower than futures? Lower than futures. Result something closer to futures. Okay, so this is one. Second step is, you don't mind investment equal to futures, investment futures, but a different strategy, because you want a result which can have an edge, result better than futures. Result better than futures and edge over futures. So these things will decide what type of strategy that you are going to do, what sort of then rollover that you are going to do, and then if you are going to do a rollover, then in that case, what type of tools that you are going to use, because whether you should be very careful to use it, because then you should use something like a spread contract in the case of putting the order execution is concerned. And if you are doing a spread contract, then in that case, which should get first, which should execute it next, because of the margin involvement, all those things. And if you do it manually also, you should ensure that buy side is executed first and sell side is executed next. These are the nitty-gritties which you should think. But what basically you have to think is these two aspects. Based on this flow, you have to construct what type of option and what type of rollovers that you will do. Okay. Now, you know that I told you in the case of this particular thing, I told you 6 to 7 spread contracts is equivalent to one futures contract in this case, as far as investment is concerned. So if you do this particular thing, then in that case I told you 40 rupees is what you invested initially. So probably you get something like 60 points or 50 to 60 points, whatever profit. That means up to 400 units on the upside. So you don't need to do anything. If it continues to rally, then in that case you don't need to do the rollover in this particular case, because you are going to get 7 units into 60 rupees profit, 420 points. So as long as the futures don't rally by more than 420 points, which is very less in 1 or 2 cases, only within a week it will happen, then in that case you can, on the upside you can just keep quiet. On the upside you can keep quiet from the place where you are doing it. Only when it comes on the downside, you do a rollover up to 300 to 400 points, which will be equal to the break-even point, which will be equivalent to the break-even point of Nifty is concerned. Because you have done 40 points up to 300 points, it will come closer to the 7 into 40 will be something like a 280 points. So that is where the futures, because the futures would have lost 300 points, and in this case also you would have lost in doing this 14 14 14 3 14s into 7, you would have also lost the same amount of 300 points. So beyond this, when you do the rollover, you may still have the same thing like a futures. Okay, you may have something very very similar to the futures. You will have the same 7 because for every 100 points it will keep going down almost at the same level. Only thing is that you need to look at, hopefully that within the week it will just jump above the spread place which you have done. Okay, and statistically what we have seen is normally Nifty the loss below 200 points or twice the option price, twice the option ATM option price is only 10 to 15% of the time. Below 400 points and all is only hardly 5% of the time. So you have something which is loaded in your favor as far as Nifty is concerned in doing the rollover. Let us see what this week we started at 17.6 and we have done up to 17.4 today. Okay, with the same 40 points with with a loss of 26 points accumulated till now. Let us say what happens if it tomorrow. Then we will look at all these things joined together and see what happens next week. So this is the discussion on this, and whatever we discuss right now, it applies as far as Bank Nifty is concerned. It also applies as far as stocks is concerned. Okay, so the concept is the same. So today we are only looking at the advantage of being an active option trader compared to the passive option trader. If you are passive, the problem comes is that if the market comes back to the same level after up and down movement, you don't do anything. It just comes and stagnates at the same place. You will lose the entire amount of option premium. So you have to avoid that. So what is the greatest disadvantage of an option? It is a time decay. So to avoid the time decay as far as possible, you should be just active enough to roll over the option. That is one thing which you can save. And as I told you, mathematically you need to find for different strikes, you need to find out how much of contract you have to do. But at the money when you do, you just need to do at any point of time 2 units of at the money, which is equivalent to 1 future. So same thing which we will discuss next week again with all the whatever happened this week. We will look at it next week. Okay. So now you can ask for your questions. You can ask your questions now. Thank you. Will Bank Nifty and Nifty recover tomorrow? We don't know. It depends on what developments that take place. But I'm sure that no, it just 17,440, 450 is supposed to be a good level for support. That has been broken. So the rally has taken from some 17,260 to 17,700. So we can have it was something like a 540 points of upward movement. So into 0.386. Now can calculate and see this whether there's a Fibonacci retracement. So 540 into 0.386, that comes to 208. 17,264 plus 208. So this was supposed to be the most important thing where it took support and bounced and then came down. And then we have the 0.235 of 540. So this is the most important place, which is 126. So 126, 17,264 plus 126, 17,000. So we look at this is 17,390, and that is also on the verge of being broken. So we have to see. This is this fall, which is below 17,390, is not a good sign. It should have definitely held on, because now we are having more than 350 points. So generally these days it should normally stagnate around 350, 370 points. Now today we are getting something very closer to that. Then the next important support comes at 17,265 itself, right, from where it bounced back, from where it bounced. So that could be an important level. So what we are expecting is that probably this will hold. 17,265 can hold, and so general feeling is that 17,265 to 17,445 now should be the important place where it should. And if it crosses again above 17,445, 450 levels, there is a chance that probably we will be again looking at some higher levels. So it has to now get itself cleared about this level of 17,450, 460 for it to bounce back substantially. So thanks for your participation, and I hope to see you next week again. Okay, thank you very much. Bye.